You know that feeling, right? That little knot in your stomach as tax season approaches, especially if your income doesn't just come from a nice, neat W-2 paycheck. Maybe you've started freelancing on the side, dipped your toes into the gig economy, or perhaps made a surprising amount from investments this year.
Right, something outside the usual.
Exactly. And
Yeah.
suddenly you're hearing whispers of estimated taxes and the dreaded underpayment penalty.
Yeah.
It's that unsettling feeling of not quite knowing if you've done enough to keep things squared away with Uncle Sam.
It's a very common experience and completely understandable. Our U.S. tax system operates on a pay-as-you-go principle.
Pay as you go. Okay.
For most traditional employees, this is handled automatically through paycheck withholding. Easy enough.
Sure, the standard way.
But for many others, that familiar system just doesn't apply to all their income, creating a gap that estimated taxes are designed to fill.
Uh-huh, okay.
And often that's precisely where the questions and, well, the anxiety begin.
Yeah, that's it, exactly. So, okay, for this deep dive, our mission really is to cut through all that confusion.
Right.
We want to demystify estimated tax payments for you.
Make it clear.
Exactly. Give you a clear roadmap, like how do you figure out what you might owe?
Mm-hmm.
When are those payments actually due?
Mm.
And maybe most importantly, how do you proactively sidestep those underpayment penalties?
Sidestep them, yeah. Avoid the extra cost.
Yeah, the dreaded ones. Think of this as, your guide to staying compliant, sure, but also really understanding how to manage your tax stuff all year.
Keep more of your money.
Right. Keep more of your hard-earned money in your pocket. That's the goal, isn't it?
Absolutely. And to do that, to give you the most accurate and actionable insights, we went straight to the source.
The IRS docs.
Yeah, the actual IRS forms and publications. Form 1040-ES, that's the main one for estimated tax or individuals.
Right, 1040-ES. Got it.
And the instructions for Form 2210, that's the penalty form, the one you want to avoid needing, really.
Okay, Form 2210 for penalties.
And also, Publication 505, which is pretty comprehensive. It covers both tax withholding and estimated tax.
So you've waded through the official stuff for us.
We have. Our goal is really just to unpack all that, sometimes pretty dense language
Oh, yeah. It could be real.
into something practical you can actually use. Information tailored for you.
Perfect. All right, let's unpack this then. We're starting at the absolute foundation because before we get into the numbers, the calculations, we need to understand why estimated tax even matters and what it fundamentally is.
Okay. So at its core, estimated tax is the IRS's mechanism to ensure that income not subject to regular federal income tax withholding still contributes to your annual tax liability on that pay-as-you-go basis we mentioned.
Right.
Imagine it like this. For most people with a W-2 job, their employer automatically takes taxes out of each paycheck. It's like a built-in savings plan for taxes.
Makes sense. It happens automatically.
But if you're an independent contractor, maybe a small business owner, or if you have substantial investment income, there's no employer to do that for you.
You're on your own for that part.
Exactly. So the government expects you to make those regular contributions throughout the year. They don't want you waiting for one big lump sum payment way later, like on April 15th of the following year.
So it's about evening out your tax payments over the year, almost like a self-imposed tax budget that makes planning easier, I guess.
Precisely. It's all about financial foresight for your taxes. And the sources of income that trigger this are quite diverse.
Okay, so what kinds of income streams typically require these estimated tax payments? Give us some real-world examples.
Well, the biggest category for many people is self-employment income.
Okay.
This covers freelancers, consultants, gig workers, anyone who typically gets a Form 1099 NEC or 1099-K instead of a W-2.
Right, the 1099 crowd.
If you're your own boss, you're also responsible for your own taxes throughout the year. And that includes not just income tax, but also your Social Security and Medicare taxes, the self-employment tax piece.
Right, because no one is taking that money out for you like an employer would. What are some other common sources that might trigger this need for estimated payments?
Beyond self-employment, we're talking about income from investments, like substantial interest and dividends.
So not just a tiny bit from a savings account.
Probably not, unless it's a lot of interest. But if you have a decent-sized investment portfolio generating regular income, that could definitely put you in this category.
Okay, what else?
Rental income from properties you own is another common one.
Landlord, yeah.
Gains from the sale of assets, think selling stocks, bonds, or even real estate, can also lead to a need for estimated payments, especially if it's a significant gain.
Like a big stock sale.
Exactly.
Yeah.
Even unexpected income, like winning prizes, getting awards, or gambling winnings, can push you over the threshold where you need to pay estimated tax.
So basically, any income where tax isn't automatically withheld.
That's the common thread, yeah. Any income where a chunk of tax isn't being automatically withheld at the source.
So this isn't just for entrepreneurs or small business owners then.
Not at all.
And here's where it gets really interesting, and frankly, where I think a lot of people get caught off guard. Even if you do have income tax withheld from a regular W-2 job, you might still need to pay estimated tax. Why is that? What's
Yeah.
the common pitfall here?
This is such a crucial point, and it's a trap many people fall into. Your W-2 withholding might be perfectly fine for your salary,
Yeah, you assume it covers everything.
but it might not be enough to cover your total tax liability if you also have other significant income streams.
Okay, give me an example.
Let's say you have a full-time job, regular W-2, but you also launched a profitable side hustle on the weekends. Or maybe you sold some stock you'd held for years and had a large capital gain.
Right.
Your regular paycheck withholding often isn't designed to account for all that additional unwithheld income.
It only knows about the paycheck.
Exactly. The IRS expects you to cover at least a certain percentage of your total estimated tax throughout the year. If your combined W-2 withholding and any estimated payments you make don't hit that mark, you could still be subject to an underpayment penalty, even if you thought your employer was handling everything tax-wise. It's a really common surprise.
So staying informed about this, understanding your whole income picture, truly provides a valuable financial advantage. It helps you steer clear of unexpected costs.
Absolutely. It's proactive planning.
On the flip side, who typically doesn't need to worry about estimated taxes? Is there a group that's usually safe?
Generally speaking, yes. If every single dollar of your income is subject to income tax withholding, meaning you're exclusively a W-2 employee and don't have any of those other significant income sources we just discussed, like big investment gains or a side business,
Just the regular job?
then you most likely won't need to make estimated tax payments. Your employer is already taking care of your tax obligations with each paycheck, assuming your W-4 is set correctly.
That makes perfect sense. But for those who are primarily W-2 employees, is there a proactive step they can take to ensure they stay in that don't need to pay estimated tax category, especially if their financial situation shifts a bit?
Absolutely, and this is a golden rule for everyone, W-2 or not. We strongly encourage you to regularly review your tax withholding.
Check your W-4 settings.
Exactly. Check your W-4. If there's any significant change in your life, maybe you get a new job, start a second job, get married, have a child, or even if your investment income changes noticeably, it's time to reevaluate that W-4.
Don't just set it and forget it.
Definitely not.
Yeah.
The IRS has an excellent free online tool for this, their tax withholding estimator. You can find it easily at irs.gov W4 app.
W-4 app, okay?
It's an incredibly valuable resource. It helps you fine-tune your withholding to match your actual expected tax liability. This helps prevent both underpayments, which cause penalties, and also overpayments.
Right, getting too much back isn't always great either.
It's not ideal. You're basically giving the government an interest-free loan throughout the year. Better to have that money in your pocket.
That's a super practical piece of advice. The Withholding Estimator tool. Now, let's navigate some of the more specific scenarios, because tax situations are rarely simple, are they?
No, they're usually not.
What about married taxpayers? How does it work with joint versus separate estimated payments? Is there flexibility there?
Married taxpayers actually have quite a bit of flexibility here, which can be a real planning advantage. They can absolutely make joint estimated tax payments.
Even if they don't live together?
Even if they're not living together, yeah, with just a few specific exceptions. For instance, you can't make joint estimated payments if you're legally separated under a decree of divorce or separate maintenance.
Okay, makes sense.
Or if you and your spouse have different tax years, which is rare but possible. Or if either spouse is a non-resident alien. Unless that non-resident alien has made a specific election with the IRS to be treated as a resident alien for tax purposes. But generally, joint payments are fine.
And making joint estimated payments doesn't lock you into filing a joint return later, does it?
That's a key point of flexibility and really helpful. Whether you make joint or separate estimated tax payments has no bearing on your eventual filing status.
Oh, interesting.
You retain the choice to file either a joint return or separate returns for the year when you actually sit down to complete your annual tax return. The estimated payments are just prepayments.
Okay, let's run through a couple of common scenarios here, because this is where the light bulb often goes off for many listeners trying to plan. What if a couple filed separate tax returns in 2024, but now they're planning to file a joint return for 2025? How does their 2024 tax figure into their estimated tax calculation for 2025, especially for that prior year safe harbor?
In that situation, it's actually quite straightforward. If you're planning to file jointly for 2025 but filed separately in 2024, your prior year tax, for comparison purposes, is simply the sum of the tax shown on both of your separate 2024 returns.
Just add them together.
Add them up. Simple.
Okay, now what about the reverse, which I imagine can get a bit more complex?
Yeah.
If they filed jointly in 2024, but now plan to file separate returns in 2025, how do they figure out their individual prior year tax?
That scenario requires a little more precision, yeah, but it's entirely manageable with the right approach. If you filed jointly in 2024 and are planning to file separately in 2025, you need to fairly allocate each spouse's share of that 2024 joint tax liability.
How do you do that fairly?
Well, the principle is to determine what each spouse would have paid if they had actually filed separate returns back in 2024, using the same filing status they anticipate using for 2025.
So you kind of recalculate 2024 hypothetically.
Sort of. Then you use a specific formula, basically a fraction, provided by the IRS in Publication 505 to figure out each person's proportional share of the actual 2024 joint tax that was paid.
Okay, there's a formula for it.
There is. The takeaway is it's designed to ensure a fair and equitable allocation of that prior year's tax liability to each individual spouse. This is essential for accurate estimated tax planning when they go their separate ways for filing.
So you're not unfairly burdened by the joint number from last year.
Exactly. It avoids one spouse carrying an unfair burden from the previous year's joint filing when calculating their individual safe harbor amount for the current year. Understanding this is a real aha moment for couples navigating that change.
That's a great illustration of how understanding these nuances can truly empower you to make precise financial plans and avoid issues. Before we move on from the who pays part, are there any other types of entities besides individuals that typically need to worry about estimated tax payments?
Yes, definitely. Estates and trusts are also subject to estimated tax rules. They use a specific form for their payments, which is Form 1041-ES. Similar concept, different form number.
1041-ES for estates and trusts. Any exceptions for them?
Yes, there's a practical exemption, which is quite helpful. A decedent's estate, or certain trusts funded by the decedent's estate, are actually exempt from paying estimated tax for any tax year ending before the date that is 2 years after the decedent's death.
So a 2-year grace period.
Exactly. It provides a crucial 2-year window, allowing the estate or trust to be administered and get organized without the immediate burden of making those quarterly estimated tax payments. It's a very practical relief provision.
That makes sense during a difficult time. Okay, now that we've covered the why and who of estimated taxes, let's get into the part that probably keeps most people up at night. The underpayment penalty. How do you steer clear of it? What's a general golden rule for avoiding this penalty?
Right. This is the cornerstone of successful estimated tax planning. And truly understanding this offers a significant financial advantage because, well, it directly impacts your bottom line. Avoiding penalties saves you money.
Absolutely. So what's the rule?
The core principle is actually pretty straightforward. You generally won't owe an underpayment penalty if the total of your withholdings, say, from a W-2 job, plus your timely estimated tax payments for the year add up to at least the smaller of two specific amounts.
The smaller two amounts, okay, like choosing the easier target.
Exactly. Think of these as your safe harbors.
Yeah.
If you meet either one, you're generally safe from the penalty.
Okay, so what are those two crucial safe harbor amounts? This is the critical information everyone needs for their planning.
All right, safe harbor number 1. You need to have paid, through withholding and estimated payments combined, at least 90% of your current year's tax liability.
90% of the tax for the year we're in now, like 2025 tax.
Correct. 90% of your 2025 tax liability, based on what you estimate it will ultimately be, that requires some forecasting.
Okay, 90% of current year tax. What's the second safe harbor?
The second amount, and this is often the easier one to calculate and hit, especially if your income is stable or increasing, is 100% of your prior year's tax.
100% of the tax shown on your 2024 return.
Exactly. 100% of the total tax shown on your 2024 tax return. But there's a vital condition here.
Always a condition.
Your 2024 tax return must have covered a full 12-month period for this 100% safe harbor rule to apply.
Okay, so it assumes a full prior year. Makes sense. So let me get this straight. If I'm expecting my income to jump significantly in 2025, maybe I landed a big contract, or got a huge bonus, I could potentially rely on just paying 100% of my lower 2024 tax liability as my safe harbor,
Yes.
even if I know I'm going to end up owing much more tax for 2025 when I file next year.
That's absolutely correct. And that's precisely the power and strategic value of this 100% of prior year tax safe harbor rule.
That sounds like a brilliant strategy for peace of mind, especially with fluctuating income.
It absolutely is. If you anticipate a substantial increase in income this year, you can choose to structure your withholding and estimated payments to meet at least 100% of your prior year's tax.
And that protects you.
This strategy can completely prevent you from incurring underpayment penalties for 2025, even if your actual tax liability for 2025 ends up being considerably higher.
Wow.
Now, you'll still owe the difference when you file your 2025 return in 2026, of course. The safe harbor just protects you from the penalty for not paying enough throughout the year.
But avoiding the penalty is a huge win in itself. That's a massive financial advantage.
It really is. It's smart planning.
Okay, are there any special rules or exceptions to this general 90%, 100% guideline? Because I'm sure tax rules are rarely one size fits all.
You're right, they're not. There definitely are exceptions, and these are vital for specific groups of taxpayers to know. First, let's talk about higher income taxpayers.
Okay, what's the threshold?
If your adjusted gross income, your AGI, for the immediately preceding tax year, so for planning 2025 payments, we look at your 2024 AGI if that 2024 AGI was more than $150,000.
Okay.
Or $75,000 if your 2024 filing status was married filing separately.
Got it. 150K or 75K MFS.
Then that 100% rule for the prior year's tax gets adjusted. For these higher income folks, the safe harbor threshold becomes 110% of your prior year's tax, not 100%.
Ah, so the IRS asks for a bit more prepayment from those with higher incomes, 110% instead of 100%.
Exactly. It's a strategically designed rule. It ensures that high earners don't significantly underpay their current year taxes by simply relying on a much lower prior year tax figure, especially when their income has likely increased.
Makes sense. It encourages more accurate payments from those with higher capacity.
Precisely. It keeps things more proportional throughout the year.
Okay, what about farmers and fishers? You mentioned they often have unique rules because their income can fluctuate so much.
You're right, they do get special treatment here too, offering more flexibility. The IRS provides a specific, more lenient rule for them.
How does that work?
If at least 2/3, that's 66 and 23% of your gross income for either the current year, 2025, or the prior year, 2024, is derived from farming or fishing activity.
2/3 from farming or fishing.
Then you get a special adjustment to the current year's safe harbor rule. Instead of needing to pay 90% of your current year's tax, you only need to pay 66.23%.
Wow, that's a big difference. 66 and 2/3 instead of 90.
It is. So their safe harbor choices become the smaller of 66.23% of the current year's tax, or the standard 100% of the prior year's tax, assuming the 110% rule for high income doesn't apply to them.
That provides much greater flexibility.
It absolutely does. It recognizes the often unpredictable seasonal nature of agricultural and fishing income, making it easier for them to manage their estimated tax payments without penalty.
That's a clear financial advantage and a necessary one for those industries. Can you clarify a bit more on what exactly counts as gross income from farming or fishing for meeting that 2/3 test?
Sure. For farming, it's pretty broad. It includes income from actually cultivating the soil, raising agricultural or horticultural commodities, or operating farms, ranches, plantations, orchards, nurseries, things like that.
So the direct farming activity.
Yes. It also covers income you might receive in crop shares for the use of your land. And even gains from selling certain livestock like draft, breeding, dairy, or sporting livestock.
Yeah.
This kind of income is typically reported on specific forms like Schedule F, Form 1040 for farming profit or loss, or Form 4835 for farm rental income if you're renting out farmland.
What about partnerships or S-corp involved in farming?
Good question. It also includes your share of gross farming income that flows through from a partnership or an S corporation, which you'd see on your Schedule K1.
But not if you're just an employee on a farm.
Correct. That's an important distinction. Wages you receive as a farm employee or from working for a farm corporation are not considered gross income from farming for this specific 2/3 rule.
Okay, that's clear. And for fishing income, what counts there?
For fishing, it includes income from catching, taking, harvesting, cultivating, or farming any kind of fish, shellfish like oysters, or clams, crustaceans like shrimp or lobster, sponges, seaweed, or other aquatic life.
So pretty much anything related to harvesting from the water.
Basically, yes. This could be income you report on Schedule C, Form 1040, if you're a self-employed fisher, Or it could be income for services you performed as an officer or crew member of a vessel engaged in fishing activities.
And similar to farming, what about partnerships or S corp?
Same logic applies. Your share of gross fishing income that comes from a partnership or an S corporation reported on your Schedule K-1 also counts towards that two-thirds threshold.
So understanding these definitions is really key to knowing if you qualify for that more lenient 66-23% estimated tax rule.
Absolutely. It's a real benefit designed for the unique cash flow patterns in those sectors, so knowing if you qualify is important for planning.
Definitely. Okay, so we know the safe harbors. Now, let's talk about how the penalty is actually calculated if you don't meet one of those safe harbors. Because it's not just one big lump sum penalty at the end of the year, is it?
No, it's not, and that's a critical nuance, one that catches many people by surprise. The underpayment penalty is actually figured separately for each of the 4 installment due dates throughout the year.
Each quarter is judged independently.
Essentially, yes. Think of it like this. If you significantly underpaid your estimated tax for the first quarter, due April 15th, you could potentially incur a penalty for that specific period.
Even if I catch up later.
Yes, even if you make up for it by overpaying in the third or fourth quarter. Or even if you end up getting a big refund when you finally file your annual tax return next year.
Wow. So playing catch-up doesn't erase an earlier penalty.
It doesn't erase the penalty that accrued during the period you were underpaid. The penalty clock runs for each quarter you fall short. It really highlights the importance of trying to meet those quarterly obligations consistently throughout the year, not just aiming for the total at year end.
That's a real gotcha for some people then. You can't just fix it all in the last payment. Is there a strategy to mitigate this, especially if your income isn't steady throughout the year? Like if you make most of your money late in the year?
Absolutely. And this is another powerful tax planning tool, though it requires more detailed record keeping. The annualized income installment method.
Annualized income. Okay, how does that help?
If your income varies significantly during the year, maybe you're a seasonal business owner, maybe you expect a large bonus or a big capital gain only in December, this method can potentially reduce or even completely eliminate the penalty you might otherwise owe for the earlier, lower income quarters.
How does it work?
Instead of assuming your income is earned evenly throughout the year, which is what the regular installment method does, the annualized income method allows you to calculate your required payment for each quarter based on your actual income and deductions as of the end of that specific quarter.
So it reflects your actual cash flow pattern.
Exactly. You annualize your income and deductions at the end of each period. If you earned less early in the year, your required payment for those early quarters will be lower, potentially avoiding a penalty for those periods.
That sounds like a fantastic option for people with irregular income. Is it complicated to use?
It does involve more detailed calculations and tracking your income and deductions throughout the year. You typically use Form 2210F, Underpayment of Estimated Tax by Farmers and Fishermen, or Schedule AI of Form 2210, Annualized Income Installment Method, to figure this out. But for those it applies to, it can be a significant tax benefit, offering flexibility and potentially saving you hundreds or even thousands in penalties.
So worth looking into if your income isn't smooth. Excellent. It sounds like there's actually a lot of flexibility and strategic planning possible if you know the rules.
There really is. Understanding these options is key.
All right, now that we've covered the why and the crucial topic of how to avoid penalties, let's get down to the brass tacks. Actually calculating your estimated tax. Where does someone even begin to figure this out for their specific planning scenario? How do you project for the year ahead?
Okay, the very best starting point almost always is your most recently filed tax return. Ideally, your 2024 return if you're planning for 2025.
Use last year as a base.
Exactly. It gives you a baseline for income, deductions, credits. However, and this is absolutely crucial, it's just a guide. It's not the final answer.
Right, things change.
Things always change. You must make proactive adjustments for any significant changes in your personal or financial situation. Did you get a new job or lose one? Get married or divorced? Have a child? Did your investment income shoot up or drop? Did you start a side business?
All the life stuff.
All the life stuff impacts your taxes. And you also need to factor in any recent tax law changes that apply to the current tax year, which, for our planning purposes, is 2025.
So it's not just plugging in old numbers.
Definitely not. It's about making educated predictions your best estimate about your financial year ahead. It's a forecasting exercise.
What are some of those what's new for 2025 highlights that we should be aware of when we're trying to project our income and tax liability for planning purposes? Any key changes?
Yes. For 2025, there are a few important updates. mostly inflation adjustments, that could directly impact your estimated tax calculations. First, and this is generally good news for many taxpayers, the standard deduction amounts have increased across the board.
More deduction is good. What are the numbers?
For single filers or those married filing separately, MFS, the 2025 standard deduction is now $15,000.
Oh, wait.
For married filing jointly, MFJ, or qualifying surviving spouses, QSS, it's doubled to $30,000.
$30,000, nice.
And for heads of household, HOH is $22,500.
So these increases mean potentially less taxable income for a lot of people.
Exactly. These bumps allow more taxpayers to reduce their taxable income more effectively, which is a direct financial advantage when calculating your estimated tax. It might mean the standard deduction is now better for you than itemizing.
That's a concrete positive for most people. Any other significant changes that could put money back in our pockets affecting credits, maybe?
Yes, a couple credits have seen increases in their income limits or maximum amounts for 2025. The Retirement Savings Contribution Credit, often called the Savers Credit.
Right, for lower and middle income savers.
Its Modified Adjusted Gross Income, or MAGI, limits have gone up. For single filers in 2025, the limit to get any credit is now $39,500. For married filing jointly, it's $79,000. And for heads of household, it's $59,250.
So more people might qualify for at least some savers credit.
Potentially, yes. It's a non-refundable credit, but it directly reduces your tax bill, which is always good. Also, the maximum adoption credit, or the exclusion for employer-provided adoption benefits, has increased to $17,280 for 2025.
That's a significant amount for families adopting.
It is, and the income phase-out for the adoption credit starts at a higher MDI for 2025, though it still phases out completely if your MAGI is $299,190 or more. These are specific benefits, but important for those they affect.
Very helpful for anticipating what deductions and credits you might be able to claim when projecting your tax. Any other key updates on the horizon for 2025 that affect calculations, like for self-employed folks?
Yes, one other significant update relevant for calculations, especially for higher earners and the self-employed, is the Social Security tax annual limit. For 2025, the maximum amount of earnings subject to Social Security tax has increased to $176,100.
$176,100.
Okay, so if you earn more than that, any earnings above that amount aren't subject to the Social Security portion of FICA or self-employment tax. This directly impacts the self-employment tax calculation for high-earning self-employed individuals.
Good to know for those calculations. All right, now let's get into the step-by-step thinking process for actually calculating your estimated tax.
Right.
We're not going to read line by line from Form 1040 ES worksheet because that's not helpful audio.
Right, nobody wants that.
But walk us through the critical components and considerations. How should someone structure their thinking to project their taxes for the year? Let's focus on getting to that required annual payment number needed to avoid penalties.
Okay, absolutely. Think of it as building your tax picture for the year, piece by piece. The first major component, the foundation, is estimating your total expected income.
All income from everywhere.
Pretty much, yes. Anticipate all your sources. Are you still employed? What's your best guess for your total W-2 wages for the year? Do you have that side hustle? How much profit do you realistically expect from that?
Okay.
Don't forget investment income interest, dividends, any rental income, any expected capital gains from selling assets, even things like alimony received, if applicable under current rules, or taxable portions of Social Security benefits.
Be comprehensive.
Very comprehensive. And for self-employed individuals, this is critical. You're not just estimating your net profit, but you also need to estimate your self-employment tax, both Social Security and Medicare parts. The good news is you get to deduct 1/2 of that estimated self-employment tax as an adjustment to income.
The deductible part of SE tax. That's a nice benefit.
It is. It directly reduces your adjusted gross income, AGI, which lowers your overall tax bill. So estimate your gross income, subtract business expenses to get net profit, calculate SE tax, and then remember to take that deduction for 1/2 of it when figuring your AGI.
Got it. So step one is really nailing down that expected adjusted gross income, considering all sources, and that SE tax deduction. What's the next big piece of the puzzle?
The next crucial component is projecting your deductions. This is where you subtract amounts from your AGI to get to your taxable income. You generally have a choice: take the standard deduction for your filing status, or itemize your deductions if that adds up to more.
Standard versus itemized? How do you choose?
You choose whichever method gives you the larger deduction, because that means less taxable income. For 2025, remember those increased standard deduction amounts we just talked about? $15,000 single, $30,000 MFJ, $22,500 Irish Hitch. For many people, especially after the tax law changes a few years ago, those higher standard deductions make it the better and easier option.
So check if itemizing, like state local taxes up to the cap, mortgage interest, medical expenses above the threshold, charitable donations,
Yeah.
actually beats the standard deduction first.
Exactly. Run the numbers. And a key point here for many listeners with their own businesses or side hustles, if you anticipate qualifying for the Qualified Business Income QBI deduction, that's the Section 199A deduction.
The pass-through deduction.
Right. You'll estimate that QBI deduction separately. Then you add that estimated QBI deduction to whichever method you chose, standard or itemized. It gets subtracted after OGI, along with your standard or itemized deductions.
So QBI is an additional deduction on top of standard itemized.
Correct. It further reduces your taxable income, offering a clear and significant tax benefit for eligible small business owners and self-employed individuals. Don't forget to factor that in if it applies to you.
Good tip. Okay, so we have AGI minus standard itemized deductions minus QBI deduction, if any. That gives us our estimated taxable income. What
Yeah.
then?
Once you have your estimated taxable income, the next step is to calculate your estimated income tax on that amount. This is where you apply the 2025 tax brackets and rates for your filing status.
Find the right tax rate schedule for 2025.
Exactly. You use the official 2025 tax rate schedules to figure out your base income tax liability. This is your core tax bill before credits or other taxes.
Are there special calculations here, maybe for investment income?
Yes, absolutely. A special consideration and a big potential tax benefit arises if your estimated income includes long-term capital gains or qualified dividends.
Right, those often get lower rates?
Yeah, they do. These types of income are typically taxed at lower maximum rates, 0%, 15%, or 20%, depending on your overall taxable income compared to your ordinary income rates, which can go much higher.
So you don't just lump it all together.
No, you definitely don't want to just lump it all in and tax it at your highest marginal rate. You need to calculate the tax on that capital gain and dividend income separately using the special lower rates. The Form 1040 ES worksheet guides you through this, or tax software handles it, but it's a significant strategic advantage to be aware of.
Good to know. Any other special tax calculations at this stage? People working abroad, maybe?
Yes, if you expect to qualify for the Foreign Earned Income Exclusion or the Foreign Housing Exclusion deduction, those amounts reduce the income subject to U.S. tax. So you'd factor those exclusions in to lower your estimated taxable income before applying the tax rates. Another clear benefit for those working internationally.
Okay, so we've got our base estimated income tax, accounting for potentially lower rates on capital gains dividends. What other types of taxes might someone need to add into this overall estimated tax calculation? It's not just income tax, right?
Correct. It's your total expected tax. So after calculating your regular income tax, you need to add in several other potential taxes. The big one for many self-employed people is the self-employment tax we calculated earlier when figuring AGI. That full amount gets added back in here to the total tax liability.
So you deduct half for AGI, but the full amount is part of your total tax due.
Precisely. Then there are other taxes that might apply depending on your income level at other sources. For higher income earners, you need to anticipate the additional Medicare tax.
The 0.9% one.
That's the one. It's 0.9% on earned income, like wages and self-employment income, that exceeds certain thresholds based on your filing status. For 2025, those thresholds are $200,000 for single, head of household, or qualifying surviving spouse, $250,000 for married filing jointly, and $125,000 for married filing separately.
So if your earnings are above those levels, you add 0.9% tax on the excess.
Correct. You need to estimate that and add it to your total tax. Another one, potentially for higher earners or those with significant investment income, is the net investment income tax, or NIIT.
The 3.8% tax.
Yes, the 3.8% IIT. This applies to the lesser of your net investment income, things like interest, dividends, capital gains, rental royalty income, or the amount by which your modified adjusted gross income, MAGI, exceeds those same income thresholds we just mentioned. $200K single QSS, $250K MFJ, $125K MFS.
So another potential add-on tax for higher earners with investments.
Exactly. These two additional Medicare tax and NIIT are often overlooked in estimated payments by those they apply to, leading to nasty surprises later. So definitely estimate them if you expect to be liable.
Good heads up. Any other taxes to include? What about household employment taxes, like for a nanny?
Yes, you generally do include estimated household employment taxes, like Social Security, Medicare, and federal unemployment taxes for a household employee, in your total estimated tax calculation. However, there's a specific, often missed exception.
Okay, what's the exception?
You don't include household employment taxes in your estimated tax calculation if both of these conditions are true. One, you won't have any federal income tax withheld during the year, like from a W-2 job. And two, you wouldn't be required to make estimated tax payments anyway if you didn't count those household employment taxes.
So if hiring a nanny is your only reason to potentially owe estimated taxes and you have no other withholding, you might be off the hook for including those specific taxes in your quarterly payments. You just settle up and you file.
That seems to be the implication, yes. It's a narrow exception, but important for those it affects. You'd still owe the taxes eventually, but maybe not via quarterly estimates. But generally, most people who owe household employment tax will include it in their estimates.
Interesting nuance. Okay, so we add SE tax,
Yeah.
maybe additional Medicare tax, NIT, household employment taxes. Anything else in this other taxes bucket?
Yes, there can be various other taxes reported on Schedule 2 of the Form 1040 that you should include in your estimate if you anticipate owing them. Things like alternative minimum tax, AMT, taxes related to retirement plans, and others. However, the instructions specifically list a few uncommon taxes not to include in estimated tax, like recapture of a federal mortgage subsidy or certain taxes on excess golden parachute payments. But for most people, the big ones are SE tax, additional Medicare, and NIIT if applicable.
Got it. So we've added up all our expected taxes. What's the next step? Do credits come into play now?
Yes. Now we get to the good part. Subtracting your expected tax credits. This is where your total estimated tax liability can really shrink.
Credits are better than deductions, right?
Absolutely. Deductions reduce the amount of income subject to tax, but credits reduce your actual tax bill, dollar for dollar. Think of credits like a direct discount on the tax you owe, a huge tax benefit.
What kinds of credits are we talking about here?
All the credits you expect to qualify for. This could include the child tax credit, the credit for other dependents, the child independent care credit, education credits like the American Opportunity Credit or Lifetime Learning Credit, the Earned Income Credit, EIC, for lower income workers, the credit for the elderly or disabled, the foreign tax credit, maybe that Savers credit or adoption credit we mentioned earlier, potentially credits for clean vehicles. Any credit you reasonably expect to claim on your 2025 return.
So you estimate all your credits and subtract them from your total estimated tax.
Exactly. You subtract your estimated non-refundable credits first. These can reduce your tax down to zero, but not below zero.
Okay.
Then, after figuring the tax liability, considering those, you also factor in any estimated refundable credits.
Wow, refundable credits are even better.
They are. Refundable credits like the Earned Income Credit, the refundable portion of the Child Tax Credit, the additional Child Tax Credit, the refundable American Opportunity Credit, or the Premium Tax Credit for health insurance marketplace plans can not only wipe out your tax liability, but can actually result in you getting money back from the government as a refund.
So even if you owe zero tax, these credits can give you cash back. That's a direct financial benefit.
Definitely. So you subtract your total estimated credits, both non-refundable and refundable parts relevant to the calculation, from your total estimated tax figure. This gives you your net estimated tax liability for the year.
Okay, we're getting close. We have our total estimated tax minus our estimated credits. Is this the number we need to pay to avoid penalties?
Almost. That number, let's call it your total expected tax for the year after credits, is important. But the number you need to pay to avoid penalties is potentially lower. This brings us back to those safe harbors.
Right, the 90% or 100%, 110% rules.
Exactly. Now you calculate your required annual payment. This is the minimum you need to pay throughout the year, via withholding and estimated payments combined, to avoid the underpayment penalty.
And how's that calculated again?
It's the smaller of two numbers. One, 90% of your total expected tax for the current year, 2025, that we just calculated, or 66.23% if you qualify as a farmer or fisher. Two, 100% of the total tax shown on your prior year's 2024 return, or 110% if your 2024 AGI was over the 150K, 75K threshold. Remember, the prior year return must cover 12 months.
So you figured out both of those numbers, and your target for penalty avoidance is the lower one.
Precisely. That lower number is your required annual payment to avoid penalties. This number is your strategic target.
So a key caution here. Paying just this minimum required amount means you avoid the penalty, but you might still owe more tax when you actually file your return next April.
That's a critical distinction, yes. Hitting that minimum required annual payment ensures you avoid the penalty. But it doesn't necessarily mean you've paid your entire tax liability for the year. You might still have a balance due when you file.
So if you want to avoid owing anything when you file, you should aim to pay closer to 100% of your current year's estimated tax.
Exactly. You can choose to pay the full estimated tax you calculated, total tax minus credits. There's certainly no penalty for overpaying slightly and getting a refund, but the required amount for penalty avoidance is that potentially lower safe harbor figure.
Okay, that makes sense. So what does this whole calculation process mean for the listener in their own planning scenario? How does this empower them?
It means empowerment, truly. This structured, proactive calculation, especially when you factor in your unique income streams, your expected deductions and credits, and those what's new updates for 2025, allows you to determine with reasonable accuracy what you need to pay and when, usually in 4 quarterly installments.
Takes the guesswork out.
It does. By understanding your safe harbor options and calculating that required annual payment target, you proactively manage your tax obligations. You completely mitigate the risk of those nasty underpayment penalties, and ultimately you keep more of your money working for you throughout the year instead of paying penalties or overpaying the IRS.
So it transforms what might seem like a daunting calculation into a powerful financial planning exercise.
Exactly. It gives you control and confidence over this part of your financial life.
That's fantastic. Now that we understand how to calculate what we might owe, why it matters, and crucially, how to avoid penalties, let's talk about proactive tax management beyond just those quarterly payments. Because it's not just about estimated tax checks, it's also deeply connected to managing your withholding from other income sources, especially through your Form W-4 if you have a job.
Absolutely. They work hand in hand. Think of the Form W-4, the employee's withholding certificate, as your primary communication tool with your employer about your withholding preferences.
It tells them how much tax to take out.
Precisely. It's how you direct them to hold back the appropriate amount of federal income tax from each paycheck. It's a dynamic tool that, when used correctly, puts you in the driver's seat of your tax withholding.
And it really is a balancing act, isn't it? You definitely don't want too little withheld, leading to penalties, but you also don't want too much taken out. Why is getting that balance right so important from a financial planning perspective?
It's crucial. If too little tax is withheld, you'll likely owe tax at the end of the year, and as we've hammered home, you could face that underpayment penalty. That's the obvious downside, unexpected bills and extra costs.
Right. Avoid a penalty.
But if too much tax is withheld, you're essentially giving the government an interest-free loan throughout the entire year.
Yeah, your money isn't working for you.
Exactly. That money isn't sitting in your bank account earning interest, it's not being invested, it's not available for your monthly expenses or unexpected needs. You lose the time value of that money until you get your refund months after filing.
Yep, so getting the W-4 right means keeping your money in your pocket longer.
Precisely. Proper W-4 planning is a direct financial advantage. It helps ensure your money stays with you, working for you, rather than sitting idly with the IRS until refund time.
So how does the W-4 help you strike this balance? What are the key steps on the form that listeners should pay attention to tailor it to their specific situation?
The current Form W-4, redesigned a few years ago, is much more targeted. Step 1 is straightforward: your personal info, and crucially, your anticipated filing status. Single, married filing jointly, etc. This directly impacts the standard deduction and tax rates used in the withholding calculation.
Okay, step 1 is basic info and filing status.
Steps 2, 3, and 4 are optional but critical for accuracy if they apply to your situation. Step 2 is for multiple jobs or if your spouse works. This step is hugely important if you have multiple jobs or a working spouse and don't account for it here. You are highly likely to underwithhold.
That's a common trap, right? 2 incomes, not enough withheld.
A very common trap leading to penalties, yes. Step 2 gives you options to account for that extra income accurately. Step 3 is where you claim dependents, like for the child tax credit, and potentially other tax credits you expect. Adding credits here directly reduces the amount of tax withheld.
So step 3 lowers withholding based on credits.
Correct. And step 4 is for other adjustments. You can enter other estimated income not from jobs, like interest, dividends, or that side hustle income, deductions you expect to take beyond the standard deduction if you itemize and have significant deductions, or simply request an extra flat dollar amount of withholding from each paycheck if you want to be sure you cover everything, or pay down your estimated tax liability.
So step 4 offers fine-tuning for other income deductions or just extra withholding.
Exactly. It allows for really precise adjustments to match your unique financial picture.
When would someone typically need to revisit and potentially adjust their W-4? What are some common life changes or financial shifts that should absolutely prompt a W-4 review?
Any significant personal or financial change warrants a look at your W-4. For instance, obviously, if your filing status changes, you get married, you get divorced, you become a widow or widower, that's a big one.
Okay.
Or if you have or adopt a child, because that impacts eligibility for credits like the child tax credit. Conversely, if a child ages out of eligibility or your eligibility for other credits changes significantly, the IRS guidance mentions a decrease of more than $500 in credits.
So changes in credits matter.
They do. Similarly, if your plan deductions change significantly, guidance mentions a decrease of over $2,300 if you are accounting for itemized deductions. Starting a new job is always a good time to fill out the W-4 carefully, considering all your household income.
Especially if it's partway through the year.
Yes, particularly if it's part-year employment. There's actually a part-year method that your employer might be able to use. If they agree and you meet criteria like not expecting to work more than 245 days that year, this method can prevent significant overwithholding that sometimes happens with mid-year job starts. Worth asking about.
Interesting. So a new job isn't just about handing over the form. It's about thinking strategically about your whole year's income and tax picture. What about those additional taxes for higher earners we mentioned, like the additional Medicare tax or the NIIT? Can the W-4 help with those?
That's an excellent point and a great proactive strategy, yes. If you anticipate owing the additional Medicare tax, 0.9%, or the net investment income tax, 3.8%, you can use Step 4C on the Form W-4 to request that your employer deduct and withhold an additional amount of income tax from each paycheck specifically to cover these expected liabilities.
You just add extra withholding.
Exactly. You estimate how much extra you'll owe from those taxes over the year, divide by the number of pay periods, and put that extra amount in Step 4C. This simple, proactive step can save you a lot of headache, helping you cover these specific tax liabilities throughout the year and avoid a large, unexpected tax bill or penalty when you file.
That's a great tip for high earners or those with significant investment income. And you mentioned the multiple jobs working spouse scenario being a big trap.
It bears repeating. If you hold multiple jobs simultaneously, or if you're married filing jointly and both you and your spouse work, it is significantly more likely that the standard withholding from each job alone won't be enough. You almost certainly need to use Step 2 on the W-4, using the estimator tool, the worksheet, or checking the box, or add extra withholding in Step 4C on one or more of the jobs to prevent underpayment at year-end. Don't overlook this.
Okay, definitely a critical point. Now, are there situations where someone can actually claim they are exempt from withholding altogether, no income tax taken out at all?
Yes, you can claim an exemption from federal income tax withholding, meaning your employer won't take out any federal income tax from your wages. However, very important, this applies only to federal income tax. It does not exempt you from having Social Security and Medicare taxes, FICA withheld. Those still come out.
Okay, only exempt from income tax, not FICA. Who qualifies?
To qualify for exemption from income tax withholding, you must meet two strict conditions. First, you must have received a full refund of all federal income tax withheld in the prior tax year because you had no tax liability. And second, you must expect to have zero tax liability for the current tax year as well.
Zero tax liability for both last year and this year.
Correct. For 2025, there are specific income thresholds tied to the standard deduction amounts that generally determine if you'll have zero liability. For example, if you're single in 2025, your total income generally needs to be below $15,000, the standard deduction amount, for you to potentially claim exempt, assuming no other complications.
How would someone actually claim that exemption on their W-4 form?
It's pretty simple. To claim exemption, you write the word exempt in the space below Step 4C on the Form W-4. Then you only need to complete Step 1A, name, address, Step 1B, Social Security number, and Step 5, sign and date. You leave Steps 2, 3, and 4 completely blank.
So just write exempt and do the basic info and signature.
Exactly. It's a very clear signal to your employer not to withhold federal income tax. However, there's a vital caveat.
Always a caveat.
If your situation changes later in the year, maybe you pick up extra work, get unexpected income, and you realize you will actually owe some income tax after all, you must file a new Form W-4 within 10 days of that change, indicating your correct withholding.
You have to update it quickly if things change.
Yes. And importantly, an exemption is only valid for 1 calendar year. You must file a new Form W-4 by February 15th of the following year to continue claiming exemption. If you don't submit a new exempt W-4 by then, your employer is required to start withholding as if you were single with no adjustments.
So it requires annual renewal. That's a good reminder that our tax situations are always dynamic and need attention. Beyond regular wages from a job, what about other types of payments or benefits that might have withholding implications we should be aware of, like certain fringe benefits from an employer?
Fringe benefits are a great example, yes. The taxable value of certain employer-provided benefits, a classic one, is the personal use of a company car can indeed be subject to income tax withholding, as well as FICA taxes.
How does the employer handle that withholding?
Your employer generally has options here. They can choose to add the value of the taxable benefit to your regular pay for a pay period and withhold tax on the total amount using the regular W-4 information. Or they might elect to withhold federal income tax on the benefit's value at a flat rate, which is currently 22% supplemental wage rate.
Okay.
There's also a special administrative timing rule employers can use. They can choose to treat taxable non-cash fringe benefits provided during the last 2 months of the year, November and December, as if they were paid in the next calendar year. This can slightly shift the timing of when that income and withholding appear on your W-2.
Good to know. What about sick pay? That can come from different places. The employer, an insurance company. How is withholding handled there?
That's another area where awareness is key. Sick pay, if it's paid under an employer-sponsored plan, is generally considered taxable wages, and federal income tax must be withheld, just like regular pay.
Okay, if the employer pays it directly.
Yes. However, if you receive sick pay from a third party, like an insurance company that administers your employer's sick pay plan, or a state disability fund, income tax will only be withheld if you specifically request it.
I have to ask for it.
Yes. You typically need to submit a Form W-4S request for federal income tax withholding from sick pay directly to the third-party payer.
And if you don't request it?
This is the critical point and a common trap. If you don't choose withholding on that third-party sick pay, or if the amount withheld isn't enough to cover the tax liability on that income, you very well may need to make estimated tax payments yourself to cover it. If you don't, you could face underpayment penalties. It's a frequent oversight that leads to unexpected tax bills.
That certainly sounds like a common way to fall short. Good warning. And what about pensions and annuities? Those are often a significant source of income for retirees. How does withholding work there?
Yes, income from pensions and annuities is generally taxable. For periodic payments, those paid regularly over a period longer than 1 year, federal income tax is generally withheld as if you were married claiming 3 withholding allowances, unless you specifically choose not to have tax withheld or choose a different amount.
So the default is some withholding, but I can opt out.
Correct. You can opt out of withholding entirely or specify a different amount or marital status for withholding purposes, usually by giving the payer a Form W-4P, withholding certificate for pension or annuity payments. For non-periodic payments or eligible rollover distributions, the rules are different. Often, a mandatory 20% withholding applies to rollovers unless directly transferred, and 10% default withholding on other non-periodic payments unless you opt out.
It sounds complicated, but the key is you can adjust it.
You can. But again, the same warning applies. If you elect no withholding or elect insufficient withholding based on your total income picture, you're almost certainly going to need to make estimated tax payments to cover the tax liability and avoid an underpayment penalty.
Okay. What about U.S. citizens living abroad receiving pensions?
There's a specific provision for U.S. citizens or resident aliens receiving pensions or annuities while living outside the U.S. They can choose to have no U.S. income tax withheld, but only if they provide the payer with a U.S. home address. If they provide a foreign address, they generally cannot opt out of withholding.
Interesting detail. And what about federal payments, like Social Security benefits? Can you choose to have tax withheld from those directly?
Yes, you absolutely have the option to choose to have federal income tax withheld from certain federal payments. This includes Social Security benefits, Tier 1 railroad retirement benefits, certain commodity credit corporation loans treated as income, and specific dividends from Alaska Native corporations.
How do you set that up?
To do this, you fill out a specific form, Form W-4V, voluntary withholding request, and give it directly to the payer, like the Social Security Administration. You choose a percentage rate for withholding 7%, 10%, 12%, or 22%.
So you can pick a rate.
Yes. And similar to all these other scenarios, if you choose not to have tax withheld from these federal payments, you absolutely need to factor that taxable income into your overall estimated tax calculations for the year to make sure you pay enough and avoid an underpayment penalty. It's all part of that pay-as-you-go system.
It really comes back to looking at your total income picture and ensuring enough tax is paid one way or another, withholding or estimates.
That's the essence of it.
Finally, let's touch on something called backup withholding. What exactly is that and why does it happen? It sounds a bit intimidating.
Backup withholding is essentially the IRS's safety net, a backup plan, to ensure taxes get collected on certain types of income that aren't typically subject to regular withholding through a W-4.
Like what kind of income?
We're generally talking about income reported on various versions of Form 1099, things like interest payments, 1099 INT, dividends, 1099 DIV, payments for services to non-employees or independent contractors, 1099 INSC, 1099 MISC, rents, royalties, commissions, potentially gambling winnings, Form W-2G.
Okay, mostly 1099 income. What's the rate?
If backup withholding applies, the payer is required to withhold tax at a flat rate, which is currently 24%.
24%. Okay. Why does it happen? What triggers it?
It can be triggered in a few key situations. The most common is simply if you fail to provide your correct taxpayer identification number, TIN, to the payer in the required manner when you set up an account or start receiving payment.
Didn't give your social security number, for example.
Exactly, or gave an incorrect one. It can also happen if the IRS notifies the payer that the TIN you provided is actually incorrect.
The IRS flags it.
Yes. Another trigger is if you're required by law to certify that you're not subject to backup withholding, usually for interest and dividend accounts, but you fail to make that certification.
Forgot to check a box, maybe.
Could be. And finally, the IRS can instruct a payer to start backup withholding on interest or dividends, specifically if they determine you have significantly underreported that type of income on your past tax returns.
Ah, so if you haven't been reporting it properly.
Correct. But the good news on that last one is the IRS typically gives you ample warning. They're required to send you 4 notices over a period of at least 210 days before they actually instruct the payer to start backup withholding due to underreporting. So you have time to address it.
That's good to know. Can you clarify what exactly counts as a TIN for our listeners?
Sure. Your taxpayer identification number, or TIN, is usually one of 3 numbers. For most individuals, it's your Social Security number, SSN.
Okay.
For businesses, it's typically an employer identification number, EIN. And for certain non-citizens who aren't eligible for an SSN but still need to file U.S. taxes or be claimed as a dependent, the IRS issues an individual taxpayer identification number, ITIN.
SSN, EIN, or ITN.
Got it.
Any special notes about ITNs?
Yes, it's important for listeners with ITINs to be aware that they can expire. If your ITIN hasn't been included on a U.S. federal tax return for the last 3 consecutive tax years, it will expire. Also, ITINs with certain middle digits have expired on a rolling schedule. An expired ITIN needs to be renewed before it can be used on a tax return. While you can likely still make estimated tax payments with an expired ITIN, you will need to renew it to file your return properly and avoid delays.
Good information for ITN holders.
Yeah.
So how can someone prevent backup withholding from starting in the first place or stop it if it has already begun?
The best preventative measure is simple. Always provide your correct TIN to payers when requested, usually on a Form W-9, request for taxpayer identification number and certification, and accurately certify that you're not subject to backup withholding when required. Most U.S. citizens and residents are not inherently subject unless one of the trigger conditions occurs.
So provide the right info up front. What if it's already started?
If it starts because your TIN was missing or incorrect, you can usually start it by providing the payer with your correct name and TIN and certifying it, again, usually via Form W-9. The payer then updates their records and stops the backup withholding, usually within 30 days.
Okay. What if it started because the IRS flagged you for underreporting interest or dividends?
That's a bit more involved. You'll need to resolve the issue directly with the IRS to get them to tell the payer to stop. This typically involves demonstrating to the IRS one of 4 things. 1, that no underreporting actually occurred. 2, that you have a genuine dispute with the IRS about whether you underreported. 3, that starting backup withholding would cause, or is causing, you undue hardship and it's unlikely you'll underreport again. Or 4, that you've already corrected the underreporting by filing an original or amended return showing the correct income and paying all the tax, penalties, and interest due.
So you have to clear it with the IRS first in that case.
Yes. It really underscores the immense importance of providing accurate information to payers and reporting all your taxable income correctly on your returns to avoid these kinds of issues.
It sounds like being proactive, informed, and accurate truly holds a lot of power in managing your tax situation effectively. But what if, despite your best efforts, life throws a curveball, job loss, illness, disaster, and you still find yourself facing an underpayment penalty? Is there any relief available? Can that penalty actually be waived sometimes?
This is genuinely good news for those who face truly unexpected or difficult circumstances. Yes, the IRS does have the authority to waive all or part of the underpayment penalty under specific conditions. Think of it as a crucial safety net for unforeseen events, a significant relief provision when life really happens.
That's reassuring. What are those specific conditions for getting a waiver? When might the IRS be willing to cut you some slack on the penalty?
There are a few key situations outlined in the law and IRS guidance. First, the penalty may be waived if, in the year the underpayment occurred, say 2024 or the year before 2023, you retired after reaching age 62 or you became disabled.
Retirement after 62 or becoming disabled. Okay. Is that automatic?
No, there's a second condition. Your underpayment must have been due to reasonable cause and not due to willful neglect. Basically, you have to show that the underpayment happened because of the retirement or disability situation, and you weren't just ignoring your tax obligations. You'd need to provide documentation of your retirement or disability date.
Okay, reasonable cause related to retirement disability was another reason for a waiver.
Second, the penalty may be waived if the underpayment was due to a casualty, disaster, or other unusual circumstance, and it would simply be unfair or inequitable to impose the penalty given that situation.
Casualty, disaster, unusual circumstance. Like a house fire or a major hurricane.
Exactly, things like that. Again, you'd need to demonstrate that the underpayment happened because of that event, and it would be unfair to penalize you for it. Supporting documentation like copies of police reports, insurance claims, or documentation related to the disaster would be crucial here.
Makes sense. Now, what about federally declared disaster areas? We hear about those sometimes. Is that handled differently for penalty relief?
Yes, that's a special and incredibly helpful situation for taxpayers. For taxpayers located in a federally declared disaster area, the IRS often provides automatic penalty relief related to postponed estimated tax payment deadlines that fall within the disaster period.
Automatic relief, so you don't have to ask.
Generally, yes. If your underpayment was directly related to difficulty meeting a deadline postponed due to a federally declared disaster affecting your area, you typically don't need to file Form 2210 specifically to request that penalty waiver. The IRS systems are usually set up to automatically identify affected taxpayers based on address and apply the appropriate relief for those postponed deadlines.
That's a huge relief for people already dealing with a disaster.
It really is. If you still end up owing a penalty even after that automatic relief is considered, maybe the underpayment wasn't solely due to the disaster timing, the IRS would typically send you a notice, like a CP-14, but the automatic relief often significantly reduces or eliminates penalties tied to those specific disaster-related deadline postponement.
Okay, that's great for declared disasters, but for the other reasons, retirement, disability, other casualty, how does one actually request a waiver if they believe they qualify? You have to ask for it.
Right, yes. For those situations, you generally need to actively request the waiver. The way you do this is by filing Form 2210, Underpayment of Estimated Tax by Individuals, Estates, and Trusts, even if you don't actually owe a penalty or even if you're getting a refund.
File Form 2210 to request the waiver. What do you put on it?
On the form itself, there's a section, Part 2, Box A or B usually, where you can check a box indicating you're requesting a waiver due to casualty, disaster, unusual circumstance, or due to retirement disability. But just checking the box isn't enough.
What else is needed?
Crucially, you must also attach a detailed statement to your tax return. This statement needs to explain the specific reasons why you were unable to meet the estimated tax requirements for the period in question. You need to clearly state the time period for which you're requesting the waiver. And as we mentioned, if it's due to retirement or disability, include clear documentation of those dates. If it's a casualty or other unusual circumstance, attach copies of relevant supporting documents like police reports, insurance reports, or official government declarations if applicable.
So it's about making your case clearly and providing the evidence to back it up.
Exactly. Clear communication and solid documentation are your best friends when requesting a penalty waiver.
Okay, very helpful to know that relief is possible in tough circumstances. Now let's shift to practicalities again. Once you've done all this careful calculation and figured out how much estimated tax you need to pay,
Okay.
how do you actually pay it? What are the modern, convenient options available these days?
The IRS has really expanded electronic payment options, making it significantly easier and more convenient than the old paper check days. Electronic payment is almost always the recommended method now, mainly because it's fast, secure, and you get immediate confirmation that the payment was received.
What are the main electronic options?
Probably the easiest for many individuals is using their IRS online account at irs.gov account. You can log in securely, see your balance, view your payment history, and make payments for estimated taxes or other balances due directly from your bank account or with a card.
IRS online account. Okay. What else?
There's also IRS Direct Pay, which is available directly on the IRS website, irs.gov payments. It's a free and secure service that allows you to make tax payments, including estimated taxes, directly from your checking or savings account without needing to create an online account. Very straightforward.
Direct pay sounds like the easiest, no-fee option for a quick payment. Are there other electronic ways if those don't quite fit someone's needs?
Yes, several others. You can pay by debit card, credit card, or through a digital wallet, like PayPal or Venmo through the processors. These payments are handled through approved third-party payment processors listed on irs.gov payments. Just be aware that these processors typically charge a small convenience fee for card payments.
Fees for card payments. Good to know.
You can also make payments using the IRS To Go mobile app. If you're using tax preparation software or working with a tax professional, you can often schedule an electronic funds withdrawal, EFW, to pay your estimated taxes directly from your bank account when you e-file your return, or sometimes schedule future estimated payments.
Okay, so through tax software too. Any others?
For businesses or individuals who make frequent or large federal tax payments, the Electronic Federal Tax Payment System, EFTPS, is often the most robust option. It's a free service run by the Treasury Department, but it requires prior enrollment, which can take a little time. So maybe not ideal for a last-minute first payment, but great for ongoing use.
So lots of electronic choices. What about traditional methods for those who still prefer paper? Can you still mail a check?
You can, yes. You can still pay by check or money order. If you do, you should make it payable to the U.S. Treasury. Include your Social Security number and your spouse's if filing jointly, the tax year, and the relevant form number. For example, 2025 Form 1040ES on the memo line. You'd mail it with the appropriate payment voucher from Form 1040ES to the address listed in the form instructions for your location.
Okay, check or money order with the voucher, but probably best to avoid cash.
Absolutely. It's critically important to never send cash payments through the mail. It's just not secure. If you need to pay in cash, the IRS offers ways to do that through retail partners or taxpayer assistance centers, but mailing cash is a definite no-no. Always opt for electronic methods, check, or money order for mail payments.
Got it. And a quick reminder for joint filers making estimated payments, either electronically or by mail. Anything special to watch for?
Yes, a small but important detail for joint filers. Ensure that the names and Social Security numbers on your payment voucher or electronic payment are listed in the exact same order as they will appear on your final joint tax return, usually taxpayer first, then spouse. This helps IRS correctly and quickly credit the payment to your joint account.
Match the order on the return. Smart. And what if you move during the year while you're making these payments?
Good point. If you change your address after you've started making estimated tax payments or filed your last return, you should notify the IRS promptly to ensure you receive any correspondence. The official way to do this is by completing and sending in Form 8822, Change of Address. You can also update your address through your IRS online account.
Okay, Form 8822 for address changes. This has been incredibly comprehensive. For those listeners who might still feel a bit overwhelmed or have very specific questions about their unique situation that go beyond what we've covered today, what IRS resources and support are available to help them navigate this?
The IRS website, irs.gov, truly is a treasure trove of information, and it's gotten much more user-friendly over the years. You can find all the forms, instructions, and publications we've mentioned, like Pub 505. They also have helpful online tools.
Like the withholding estimator we talked about.
Exactly. The tax withholding estimator at irs.gov W4 app is invaluable for adjusting your W4 throughout the year and should be a go-to tool for anyone with wages. They also have an interactive tax assistant tool, irs.gov Help IT, that can provide answers to common tax law questions based on your input, plus robust FAQ sections and search features.
So the website is the first stop. What about free tax preparation services for those who might qualify and need help actually filing or calculating?
Yes, the IRS sponsors several excellent free tax preparation options, especially for lower to moderate income individuals, the elderly, and those with disabilities or limited English proficiency. IRS Free File allows qualified individuals, based on income, to prepare and e-file their federal income tax returns for free using guided tax software provided by commercial partners. You can access that through irs.gov Free File.
Free file for online prep. What about in-person help?
There are two main volunteer programs. The Volunteer Income Tax Assistance (VITA) program offers free basic tax return preparation for people who generally make $64,000 or less per year. For tax year 2023 filing and 2024, check for updates. Persons with disabilities and limited English-speaking taxpayers.
VITA for lower moderate income.
And the Tax Counseling for the Elderly (TCE) program provides free tax help specifically for all taxpayers, particularly those aged 60 and older. TCE volunteers are often retired individuals associated with nonprofit organizations and specialize in questions unique to seniors, like pensions and retirement-related issues.
TCE for seniors. How do people find these VIT or TCE sites?
You can find locations and information for both VIA and TCE on the IRS website, irs.gov VDAT, irs.gov TCE, or by calling the IRS helplines. They operate thousands of sites nationwide, often in libraries, community centers, schools, etc., especially during tax season.
That's fantastic. Free help available. Now, for those who don't qualify for free help or have more complex situations, they might hire a tax professional. Any advice there?
Hiring a qualified tax professional can certainly ease the burden and provide valuable advice. However, it's crucial to remember that you, the taxpayer, are ultimately responsible for everything on your return.
The buck stops with you.
It does. You're responsible for providing the preparer with all the necessary accurate information, and you're responsible for the accuracy of every item reported. So choose your preparer wisely. Look for credentials like CPAs, enrolled agents, attorneys, or participants in the IRS annual filing season program. Check their history, ask about fees up front, and make sure you understand the return before you sign it.
Good advice. Choose carefully and stay engaged. Finally, what if someone is having a significant unresolved issue with the IRS? Maybe a mistake they can't fix, a collection issue causing hardship, something they just can't seem to resolve through normal IRS channels. Is there a higher level of support or an advocate they can turn to?
Yes, absolutely. If you've tried to resolve a tax problem through normal IRS channels and haven't succeeded, or if you're facing significant financial difficulty because of an IRS action, or you believe an IRS system or procedure isn't working as it should, there's the Taxpayer Advocate Service. TAS.
Taxpayer Advocate Service. Are they part of the IRS?
TAS is an independent organization within the IRS. Their job is literally to be your voice inside the IRS, to help protect taxpayer rights and help taxpayers resolve problems that haven't been fixed through normal channels. They can help with a wide range of issues if you meet their criteria.
When can TAS typically help?
They can step in if your problem is causing financial difficulty for you, your family, or your business, if you face an immediate threat of adverse action like a levy or seizure, or if you've tried repeatedly to contact the IRS but no one has responded, or the IRS hasn't responded by the date promised.
How do you reach TAS?
You can find contact information for your local taxpayer advocate on their website, taxpayeradvocate.irs.gov. Contact us. They also have a toll-free number, 877-777-4778. Information is also an IRS publication 1546.
That sounds like a really valuable resource for tough situations. Is there anything else like that?
Yes, related but distinct are the low-income taxpayer clinics, LITCs. These are not part of the IRS or TSS. They are independent organizations, often funded by grants from the IRS, but run by law schools or legal services organizations.
The LIPCs, what do they do?
LITCs provide free or low-cost assistance to individuals whose income is below a certain level and who need help resolving tax disputes with the IRS, such as audits, appeals, and tax collection matters. They can actually represent taxpayers before the IRS and in court. They also provide education about taxpayer rights and responsibilities, often in multiple languages.
So legal help for low-income taxpayers with disputes.
Exactly. You can find a list of LITCs in your area on the TAS website at taxpayeradvocate.irs.gov LITC or in IRS publication 4134. These resources, TAS and LITCs, are truly there to support you when you're navigating the more challenging or complex side of tax issues.
That's incredibly helpful to know those avenues exist. So let's wrap this up. What does all of this mean for you, our listener? We've covered a huge amount of ground today, from the why of estimated taxes to the how of calculating them, avoiding penalties, managing withholding, and finding support.
We truly have. The key takeaways for you are pretty clear, I think. First, estimated tax payments are essential if you have significant income not covered by traditional withholding. Think self-employment, investments, rentals. It puts you in control of paying your taxes on time.
Be proactive about non-withheld income.
Second, understanding that general rule for avoiding penalties, that critical safe harbor choice. The smaller of 90% of your current year's tax, or 66-23% for farmers fishers, or 100%, sometimes 110% for higher income, of your prior year's tax, that's your ultimate defense against unexpected penalty costs. Knowing your target number gives you real financial peace of mind.
Know your safe harbor target.
And third, don't forget the power of proactively adjusting your Form W-4 if you do have a job with withholding. Even small tweaks there, using the IRS withholding estimator, can be a powerful tool to fine-tune your tax payments throughout the year, potentially reducing or eliminating the need for separate estimated tax payments, or just making sure everything is covered accurately.
So leverage that W-4. By taking control of your estimated taxes and withholding, you're not just dodging penalties. You're really empowering yourself to manage your finances more effectively.
That's exactly it.
You ensure you're paying exactly what you owe when you owe it. And ultimately, you're keeping more of your money where it belongs, in your own hands, working for you, not tied up with the IRS unnecessarily or paid out in penalties.
And you know, this whole discipline of quarterly estimated tax planning, while it might seem like just another compliance task, it actually offers a fascinating parallel to broader financial management, doesn't it?
How so?
We'll consider how this structured approach, forecasting income, anticipating expenses, in this case taxes, meeting regular payment deadlines, how might that translate into other areas of your financial life? Could this consistent, forward-looking approach required for your tax obligations actually teach us valuable lessons about budgeting more effectively day to day, about building a disciplined saving habit, or about getting better at financial forecasting for all our broader personal and professional goals?
That's an excellent thought-provoking question to leave you all with. Could mastering estimated taxes actually make you better at managing your overall finances? Something to ponder. We certainly encourage you to use the IRS tools we've discussed today. Revisit your tax planning regularly, especially for situation changes, and apply this powerful knowledge not just to your taxes, but potentially to your entire financial picture.